Welcome to the Chapter 3 video lecture for Accounting 624. This chapter is all about the tax formula, a little bit of an overview, largely focuses on individual, which is why in this video and in the matrix that
I know Kung Fu.
provided, you're going to see that some of the areas we give a pretty soft touch to. So we start kind of with a focus on the overall tax formula, really as it relates to individuals, because the non-individual tax formula couldn't be easier. And then we dig in on a couple items that you need to know what they are, but we're not going to go into the definitions of those things. So things like the standard deduction, exemptions, filing status. You need to understand what those are, but you don't need to be able to define them. So, for example, I'm not going to put you through the ringer of, establishing whether someone's head of household or single, whether someone is a surviving widow or widower, or are they an abandoned spouse. I'm not going to put you through the dependency tests. Is it a qualified child? Is it a qualified relative? But I do want you to understand what dependents are. And I do want you to understand the different filing status because, of course, that changes the tax rates. It changes the phase outs of certain deductions and credits. And if they come back someday, it will affect exemptions as well. So those we'll have a light touch on. So I've asked you to read them. Number one is that material is on the CPA exam, but we just don't have time to fit that into this class. However, it is an integral part of Accounting 503, which is individual income taxes. So if it's something that really interests you, you can go there, or you can just volunteer for a VITA program. We have one here on campus. It operates during the spring, so maybe next spring or something like that. So we do cover then some basic blocking and tackling about how to calculate tax. It's all pretty straightforward. So this is another chapter that I find is a little bit esoteric. It's not really digging in too deep. That's going to start though, 4 and 5. We'll start digging into some issues that will feel like tax for sure. But with that said, hey, let's get started. All right, we get started by visiting our old friend, the basic tax formula. Tax equals rate times base. And if I haven't said it before, I will say it now. Rates are actually pretty straightforward, even though some people would argue they're complicated. Why do we have so many rates? As you're going to find as we work through this, the rates are actually really standard and easy to deal with. It's the base that is complicated. So if you hear politicians saying we're going to reduce the number of rates to simplify taxes, that really doesn't simplify them. Simplifying them would be changing the way we calculate the base. So that's what we're going to spend time on starting today. We're going to talk about an expanded base computation. And that way you'll start to be able to piece together all the different tax provisions and how they'll apply when we calculate taxable income. All right, so here's the base for income tax. And we start at income, and then we're able to exclude certain items of income. We'll cover that in the next chapter, the next 2 chapters, actually. And then that gives us gross income. Total up all your gross income, and then you take deductions for adjusted gross income. So that's deductions above the line. Then you get to your adjusted gross income. And then you are eligible to take deductions from adjusted gross income or from AGI. That's your standard deduction or itemized deduction and your qualified business income deduction. And that's what gives you taxable income. To that, we apply a rate. You get the tax before credits. And then in our current system, and probably the system that we'll have for a while, there are a number of tax credits that you apply against that tax to get to net tax liability. So starting with gross income for tax purposes is defined under Code Section 61. Gross income means all income from whatever source derived. The regulations go on to say that that includes income realized in any form, money, property, or services. And just as a mild quirk to the gross income definition, it does also include a deduction for cost of goods sold. So I always find that interesting, but in fact, gross income is already reduced by cost of goods sold. You will recognize as a taxpayer gross income when you receive an economic benefit. That income has been realized, and we contrast that with unrealized income. And there's no tax provision that allows the taxpayer to exclude or defer that income, which would be there's nothing that allows them to not recognize the income. So realization, recognition, two different things.